All right, so welcome to another video, and today what we're going to do is we're going to take a look at the wheel option strategy, and we're going to just break it down. Keep in mind, none of these are recommendations to buy, sell, or trade anything. It's just my own personal opinion, and I definitely encourage you to also check out some of the other great stuff I have available on the tradersfly.com website. We have some live classes coming up. Ultimate adjustments are some of the old classes we have, how to construct a portfolio, trading single options, covered calls, and much more. So anyways, you can also check out the Discord channel as well to just get some insight on some of the stuff we have going on the charts. But let's kick things off with the wheel strategy. And let me just break this apart for you. And here's what we're going to do. I'm going to go ahead and do this on the paper trading platform for you on Apple. So the wheel strategy, the whole point behind it is you're just going kind of looping and over, continuing this cycle. So what we do is we start with kind of a put selling. And what we're trying to do is get the shares assigned to us eventually. But if we don't, it's okay. We collect money and premium waiting for it. Eventually, we get the shares assigned because we have to have enough cash to be able to sell those puts naked. And then once we get those shares assigned, we will sell calls against it, okay? Now, we'll keep selling calls against it until the stock is gone, and then we'll go ahead and get back to selling puts. So the point is when you sell the puts, you're buying or trying to buy that stock at a lower level, okay? So let's say a stock just kind of keeps going down. You sell the puts, and then eventually you'll come to your point, you buy the stock at the point where it starts reversing, and then you start selling calls, and eventually you get called out. So again, you keep selling puts. And if the stock just continues to head higher like this, you could be selling puts a couple of times, winning, once, twice, three times, and eventually you will get kind of assigned. And the further it's stretched, kind of the further out you could go ahead and sell the puts. So let me give you this breakdown here on this strategy and just give you some insight. So let's say we're looking to trade Apple here. And the first thing I want to do is go ahead and sell the puts on it. So I'll go ahead and I'll look at the chart first real quick, and I'll say, hey, let me take a look at Apple. How far up is it, or how far down is it? And if the stock is very extended, like let's say the stock is super extended like it is over here. So if it's been going up for a while, I might go longer duration, because if I'm way up here, I need to go longer duration because it probably could fall back. So with longer duration, I could get further out. So in that case, I might do 30 to 60 day put selling way up here. However, once this stock is pulled back, if I'm in this range, I might actually just do like 15 to 30 day out. So again, you can define your parameters because here we're looking for a possible pop soon. So I'd rather sell puts more frequently because, when you're selling down here, you'll probably get a pop. And in that case, you're kind of in your favor to go ahead and sell the puts in that side. So in this case, I might say, okay, well, let me go ahead and do something around the 17 days or 24 days. So I could start with the 24 days if I'm still worried about a market pullback. And I could go, okay, 150, and I'll sell the put right here. So I'll sell the put, and I'll say, okay, well, what delta should I sell? Right here, I'm looking at somewhere between a 10 and maybe a 25 or 30. And I'm going around this range. Again, if the stock's been pulling back quite a lot, you could actually go way further out. If you're really toppy, you could go further out as well to, make sure you don't get as assigned, but chances are you will probably get assigned with the strategy. So you need to be prepared for it. So I'll go in and I'll sell a single, and you can analyze this trade, what it looks like. So here, if the stock stands still, I make money. So I make $109 waiting for that stock to come back to $150 a share. If it goes up, I still make that $109 at expiration. I could get out of it early if I like. If it pulls back even over here and it still expires, I'm okay. I still collect that money. The big downside is when it goes to like 140, and then you get assigned to 150. So that's a bit of the issue, but it can happen. So anyway, so first off, what we're going to do is we're going to go ahead and sell the put. And remember, if it goes under 150, you will get assigned the shares. So here, I'm just going to go ahead and place that single put. So there we go. So now we've got that put that we've sold. So now you kind of wait and you wait and you wait until this premium you get assigned. If it doesn't get assigned and this just expires worthless, then what you can do is, I'll just show you kind of one example here on Facebook. It's already been going up for a little bit. Okay, so here, this one's a vertical actually, but I'll just take the put side here. You can see you're already profitable about $112 out of a max profit of 176 here. So I'm up about 112. So what I can do is actually close this trade out early if I like and sell a different one, or I could just let it expire. Anyway, that choice is a little bit up to you depending on how you like to trade. I'm gonna go ahead and close this trade out, but just to show you, hey, you know, once it goes up, you could close it out early. So once we do get that assignment on our Apple shares, so let's say we do it once, we collect the premium, nothing happens. We do it twice, again, nothing happens. We sell it, keep selling it a couple times later. So we do the May, then we do the June, then eventually, finally, we get assigned maybe in July, and we get 100 shares. So I'm going to go ahead and replicate this. And let's say we've got 100 shares now that we get assigned. I could confirm and send that order in. So now we are left with 100 shares. Okay, and our put would be gone. So I'll close that trade. Okay, so now our put would be gone. And we would be left with the 100 shares of stock right now. So now what is it that we do? We would go ahead and just repeat this process, but do the call side now. So let me close this out real quick. It's still working on the order. I'll try to, you know, push that order through a little bit. Just, there we go, got filled. So now we are left with this order here with 100 contracts, or sorry, 100 shares. And now I could go ahead and sell the calls. Now, if the stock is toppy, I could sell a closer in call. If the stock has pulled back quite a bit, which because of the put, I could sell a further out call. So I could do like, you know, 17-day or 10-day. So I could go ahead and do a 10-day and do something at 172. So because let's say I got assigned at about 165, I could now do a 172. And now as this stock goes up, I go ahead and make premium if it goes up and expires, because I make money from my 100 shares. Also, if it goes up slowly, I get to keep my stock and I collect the premium. And the premium that I'm making here is $146. So as long as the stock is below 172.5, I get to keep the stock and make the premium. But if it blows past this, I lose the stock. Okay, so this is known as covered call. So I'll go ahead and now sell this call against it. Boom. And now I've got my position. Now, eventually, if this goes up, and it just expires right here, all you can do is you collect your premium and you could sell the next week, 14 days, 20 days, 7 days out, and do it again, just to go a little further out and continue the process. And then you'll be back to selling the puts after the stock is gone. So after you do this 3 or 4 times, you might lose the stock, and then you'll go back to selling puts. Now, I want to share with you a couple of quick little tips regarding this strategy, and that is, number one, can you, if the stock is starting to tank and sell off pretty quickly and you already got assigned, can you go ahead and sell some more calls against it? Yeah, you would probably then sell something a little bit closer in with a stronger delta, or you could even sell 2 calls against it. You don't have to sell just one. You could actually sell 2, but this creates an inversion risk where if it does snap up, you could get into a little bit of trouble. So you could see what's happening here is I've got kind of some room on the upside, but only a handful. And then actually I start losing money on the other way. So just understand that this could be another way of doing it. Okay, so yeah, this is the IRA kind of platform, so it won't let me do that. The other thing you could do is actually go in and could you sell puts against it even further? Like, let's say you've got more capital and positions. Yeah. So you got assigned once. You could say, okay, well, I'll go ahead and sell some more puts. Like, let's say now the stock is heading higher and you just got assigned, right? So you got assigned and you're dealing with covered calls. Could you go ahead and now sell more puts if you got 100 shares? Sure. And even if you sold the covered call already, could you go ahead and sell more puts? Yeah, absolutely. You could go ahead and sell it again. And you could say after, let's say 500 shares, I'll stop. So now you could pick up some shares at 145, and you could say, hey, I'll sell some puts here and go ahead and sell a put. So you could actually be working the strategy on multiple share fronts where I've got some puts working, and you could say, hey, I got some puts working and waiting for those shares to get assigned. And then I've got a call working on the 100 shares that I already have. So it's kind of like if it keeps pulling back, then you'll get another 100 shares. And you could do this and put a stop in your place where saying, hey, after 400 shares, that's it. I only sell calls against it because I'm just overextended. So be a little more careful if you do this too much or too many contracts. Because you will start overextending your position size. So you want to be mindful of that. But in general, you could actually do two puts, 3 puts. You could have a lot of puts here working, like, 24 days. You could have some like, 50, 60 days out even, where you're selling puts even at the 125 here. Simply because you found it was a good value, the stock maybe dipped quite a bit, or maybe you have more capital there that you want to put to work. And then what you'll do is you'll have much more allocation at different price points. And you'll have some at 125, 145. And then as you get assigned, you'll collect them at lower levels. And that's kind of the point. But if they head higher, you still collect that premium of, $50 here, $100 here, and just picking up little change kind of on the ground or on the floor as you see it. That's kind of what you're doing here in this situation. So anyways, that's kind of the basics behind a wheel strategy. To break it down again, you're going in and you're selling puts on stocks you believe are heading higher in the long run, and that you'll be able to do for the long haul. Once you get assigned, okay, then what you do is you go ahead and sell calls against it. Eventually that stock is gone and you go back to selling puts. So when you sell the puts, you'll get assigned. You might do this once, twice, 3 times, and then you get that assignment by selling the puts. Once you get the assignment, you can sell calls, and then eventually that stock, you might do it once, twice, 3 times, and then by maybe time number 5, 7, that stock will be gone and you could go back to selling puts. And you could do these simultaneously. So you could be selling puts on another lot or size while you're selling calls on another lot. You could sell multiple calls or multiple puts. It's just really depending on the capital size and what you're comfortable with managing multiple positions. And but that's kind of the wheel strategy, just continues to loop through that cycle to bringing you in consistent premium income from selling calls and selling puts. Anyways, I hope that helps. Truly appreciate you joining me. Thanks again for sticking by. Feel free to grab some freebies on our website. Check out some of the live classes we have going on, and some of the older recorded sessions as well, where they're really in-depth education about learning options. And I hope to see you in one of the next sessions or classes. Thanks. Take care.